What's up, y'all? Welcome to episode 3 of Assets Under Management. It's your boy FinanceKeem, and this week we got a lot to get into. So first, we're going to talk about what happened in the market this week in our new economic news. I got a new asset that we're going to define this week in our Let's Define Assets section, and then I'm going to take y'all into my portfolio peek and what I'm looking for, why I'm looking for it, and actions that I'm going to take. So stay tuned, lock in with me. You're watching Assets Under Management. What's up, y'all? We're not going to waste any more time. We're going to jump right into it. So, in our new economic news, let's talk about where the stock market closed. And when I mean the stock market, I always reference the S&P 500. All right. Some people may watch the Dow, some people may watch NASDAQ. But on this channel, I'm always referring to the S&P 500 when I say the market. So, where did we close at this week? Well, remember last week I talked about the whole cycle levels, right? And we were at 440 and see if we could break above 442, the 442.4 area. Well, we actually did that. And we went all the way up to our next whole cycle level, which was 450. Now, on Thursday, we tried to get above 450. Didn't really get there. Got rejected right around the 458, 459 area. But Friday, we did actually break above the 450 level or the 4,500 on the SPX, which is the actual index of S&P 500. And so we broke above the 450 on SPY. We went up to about 451, and then we came crashing back down. That lets me know that there was buyers at that level. The buyers were at that level. They tried to push it higher, but then sellers came in and they pushed it back down, letting me know that this whole cycle level was a strong level of resistance and supply was in the market. So let's see if next week we do a bounce and retest, meaning that I think we could come back down to 448, 445-ish area and see if we could push back on up off of the 445, break through the 450 and maybe off to new heights. Now, there's been a lot of economic data that came out. A lot of it was good. PPI, CPI came out lower than expected or forecasted. And the banks actually came out and they put their data in saying that there's been a lot more deposits off of this last month, which is June. There's been a lot more deposits relative to the previous month. So the deposits in the banks are going back up, which is letting me know and letting economics know that us as consumers, us as citizens and partakers in the economy, we are getting more confident in the economy. We're getting more confident in the banking system. We're getting more confident that we might miss out on a recession. So we can see that if the sentiment is there, if the consumer confidence is there, maybe we will hit that 448, 445 level, bounce off, and finally break through the 450. That's just my prediction. Let me know what you think in the comments. And other news, QQQ, which is the NASDAQ 100, also one of the indices that we watch. QQQ is scheduled for a rebalance on July 24th. Now, what a rebalance means is that there's 100 stocks in the portfolio of QQQ. And as of right now, 7 of the stocks, I believe it's 7, let me count: Apple, Netflix, Microsoft, Nvidia, Amazon, Tesla, 6. 6 of the 100 stocks are accounting for 43.8%, a whopping 43.8% of the entire portfolio. So what NASDAQ wants to do is rebalance, make sure that they can get that percentage down to 38.5%. Those 6 stocks representing only 38.5%, which is still a lot, but is not being overexposed to the 6 stocks. And that's what they don't want to do. They don't want to be overexposed to just 6 stocks. They want to give the other stocks a chance to have some weight in the index. And so that's all a rebalance is. I'll be sure to look out to see if the Dow Jones is going to do it, if the SPY is going to do it. I think the SPY is doing it, but I did not receive confirmation yet. So I will let you guys know next week if the SPY and the Dow Jones are doing a rebalance as well. But July 24th, make sure you guys look out for the rebalance. If you are in the NASDAQ 100 doing any plays, trades, or anything like that, make sure you look out for this on this date, because we don't know. It could take a dip as some of these maybe over leveraged stocks get a higher weight, bringing down the average and the momentum. Obviously, these 6 stocks has been carrying the NASDAQ 100 and the SPY for all of that matter. So less percentage of these stocks will ultimately affect the performance of the stock. So make sure you're watching out for this. All right. And for our next segment, we're going to define some assets. So stay tuned and let's define an asset. And now let's get right into it. Our next segment, let's define the asset. Today we're going to be talking about 401ks. What does 401ks mean? How does it get its name? Where does it come from? How does it start? What's the purpose? So a 401k is actually not the name of the product. It's actually a section in the IRS code. The government has allowed the consumer or the employee, anyone who works, to allow tax defer income. So they can take a portion of their income and defer it for taxes at a later date, which is essentially what you do when you put money in a 401k, right? So you take a portion of your money, your employer takes it out of your checking, and they put it into this account to grow tax deferred. Well, some of these employers also match a percentage of what you put in. So if you put in 5%, 10%, some employers may match up to 3%. Some employers may match up to 5% of whatever you put in. They'll match it, and then they will allow that money to grow and accumulate over time. So when you're of retirement age, because it is a qualified investment account. Now, what does that mean? This isn't a qualified account, meaning that it is tax deferred. So when you pull out this money, you have to wait a certain age, which is 59 and a half. You pull out this money, you will pay taxes on the money at age 59, whatever tax bracket you're in at age 59 and a half. If you decide to pull out the money prior to 59 and a half, outside of any exclusions that you may have on a 401k, such as medical emergencies, such as transferring into a different type of IRA, you will receive a 10% tax penalty. So if you pull out 100 grand, you will receive a 10% penalty on that and then pay taxes on top of that. So just be mindful of how you use this 401k. So let's get into how the 401k was started and what it's meant for. A lot of people know what the 401k is because they participate in it for their job, but they don't really know why it was started. So let's go all the way back to the 1970s. If you remember, around this time, a lot of people had blue collar jobs. Now, these blue collar jobs offer something called a pension. Now, a pension is when you work a certain amount of years. Most of the time, it was 20 years, 40 years. You work these 40 years, and then the job says, okay, in your retirement, we're going to pay you out for life. We're going to pay you a certain amount for life because you worked with us. Now, there is a calculation that figure out how much you get paid is based off of the last 5 years that you work and your salary, and then a percentage of that. So let's just say, for example, if we made 100K over our last 5 years, then they would take the percentage, which is usually 60 to 70% of our income. So we'll get paid 60,000 to 70,000 each year in a pension for retirement, which is pretty good because you put in 40 years of work with this one company just to get that. So they would expect that you would, live to the life expectancy range of, for men, let's just say 76. So you retire at 65, they pay you all the way out to 76. Well, if you live past that, now they have to keep paying you money. So if you live up to 100, that's 25 extra years that's not accounted for in a pension that they have to pay out legally. And so this product, as they seen that life expectancy was getting longer, because the technology is getting better, medical information is becoming more prevalent, the internet age, a lot of people can do research, whatever have you, life is getting better. We are living longer. So they're saying that the pensions are starting to cost money. And so the pension was the real retirement product back in the early 1900s all the way up into the 1970s. And then the government allowed to switch it up and do a 401k in 1978. Well, this 401k was never really meant to be the sole product for retirement. Now, a lot of people are using this along with the Social Security, which is almost a different type of pension. A Social Security with the 401k as their retirement income. But I'm here to tell you that the 401k was not meant to be a sole product for retirement. So if you have a 401k and if you are using that as your sole form of retirement, maybe relying on Social Security, listen, it's something that you need to know, and it's that this is not the product for you to be solely reliable on your retirement. Now, unfortunately for you, I wrote a free ebook that you can download. If you go to my website, go to the link in my bios on social media. It's a free ebook. All I need is your name, your email. I will send it to you, letting you know what is reliable, why the traditional methods of retirement is not reliable for you, for me, for anyone. Yes, it will work for some people, but for the mass majority is not reliable. And in this book, I break down what is reliable, how do you get it, how do you build these things, how do you build the bulletproof retirement blueprint, the bulletproof retirement plan, how do you build a trust fund for your family, how do you protect your income, protect your life, and different things like that. So if you want that book, please click the link in my bio, get this information, fill out the form, and I'll send you the book. All I need is your name, your email. If you can't find it, just leave a name in the comments. I'll get back to you. DM me on social media. I'll get back to you. It's time for my favorite portion of the episode, which is the portfolio peak. Y'all know me. Y'all know I love trading. Y'all know I love everything about finance. I actually do this professionally. So you know I love it. I'm all in, right? I'm all money in, as my guy Nip said. Um, and so that being said, let's take a look at what I'm doing in my portfolio peak and how I'm performing, some things that I like, some things that I don't like, and the actions that I'll be taking moving forward. So as you guys know, last week I started the account. I added $200 to the account, and I will be doing so monthly for the time being. Now, again, it may go up to more than 200 in the future. I will let you guys know, but it's right now it's 200 per month. So I added the 200, and because we have a rebalancing of these indices, particularly QQQ, and again, I'm not sure if it's going to affect the S&P 500 and the Dow. I want to wait until after July 24th to figure out, to take actual action. But while I'm using these 2 weeks or this week, I'm sitting on the sideline. I'm accumulating any cash that I have or any cash that I want to put into the account, and then I'm developing a game plan. So right now, I think I want this account, the primary focus of this account, to be a dividend portfolio. And as of right now, some dividend portfolios or some dividends that I'm looking at is actually REITs. If you know anything about REITs, REITs are basically trust that real estate companies use, and legally it's set up so that legally they have to pay out 90% of their profits to shareholders. Now, if they don't pay out 90% of their profits to the shareholders, then they get taxed at a maximum tax rate. They don't want that, so they'll just pay out the 90%. Now, keeping 10% of profits is way better than than paying out, the umpteenth millions of dollars in taxes that they'll have to pay. But because keep in mind that these companies are making billions of dollars annually. And so they don't want to pay taxes on that. So they'll rather just give it out to the shareholders in dividends. And there's a bunch of companies that you can get that will pay you out monthly. A lot of them pay you out quarterly. So one of my favorites is Old Realty. Old Realty has a lot of properties with like movie theaters, LA Fitnesses, Giants, a lot of places that we go on a regular outside of the movie theaters because of the pandemic. But a lot of places that we go on a regular, like grocery stores, the gym and different things like that. They're getting the rent from these companies who are renting the land or the property from Old Realty. And so that's just one example of a company that I will be looking into to invest. Now, I do have that in some other portfolios, so that's why I know a lot about it. But as far as this portfolio, I do want to make this a staple. Now, my goal is to accumulate enough shares so that the dividend will buy at least 10 shares annually, because dividend stocks really don't move. They don't fluctuate. They don't offer high growth. And so for the how do you want to say it? The compensation for owning the stock but not getting high growth returns, you get the dividends, and then a REIT on top of that, they have to pay out 90%. And so this is one of them, Zim, ZIM. This is another one that I'm looking to add. This is the shipping container company. Now, as we know, during the pandemic, there was a shortage of pretty much everything, including the shipping containers. Zim blew up in the pandemic. The stock really came back down after the pandemic. But I do think it's a pretty reliable company. They do offer huge dividends. They give dividend bonuses maybe once a year. This year in April, I believe they gave a dividend of $7 per share. So if you go back and you look how many shares you could have get for the price where it's at, about in the 20s, how many shares you could have got if I just put maybe 100, let's just say $125 that it gave me 5 shares, I could have got $35 in dividends and just one dividend payment. So that's just some things to think about. Those are the two companies that I'm going to be looking at until the rebalances come around. And then when the rebalance come around, I'm going to put in, I'm going to definitely develop some holdings into the S&P 500. I do like VOO, so I will be investing in VOO, which is a Vanguard form of the S&P 500. It is cheaper and it does pretty much the same thing. So it all depends on what you like. You know, if you like Spider, the company, if you like Investco, which is the QQQs and all the Qs, if you like Vanguard, which is a lot of the stocks, ETFs, indices that have a V in it, then it's all about what you like. Go do your research on differences in these companies, how they manage the portfolio, the fees, because a lot of these companies do have fees that when you invest into it, you do have to pay fees. They will take it out of whatever dividends or something like that they charge. So just do your own research on that. So I will be starting, to be clear, I'm going to wait until the 24th, but I'm going to put money on the side to start my positions in VOO. And then we're going to move to O Realty, and I'm going to look at Zim. Zim will be the last one because it's not the most stable. As far as the stock, there is some volatility that goes there, but I do like the company a lot. And shipping to me is not going anywhere. They can only go up unless they crash the company as far as losing shipping containers or broken ships or different things like that. And so that's going to be my portfolio peak. I'm gonna give it to you one more time. I'm going to start with VOO after the 24th. Then we're going to look at O Realty, and then we're going to look at Zim. And then I'm going to go in and find a couple more, maybe 2 or 3 more really prevalent dividend stocks that I want to add to this portfolio. Maybe something that offers a little bit of growth accumulation. I think Zim does offer that, and then I want some more staples. Maybe Apple. I don't really like their dividend. It's not the best, but they do offer a lot of growth potential. And everything I touch is Apple. I'm recording on the iPhone. I have an iPad right here. I have a MacBook upstairs. I have, the Apple TV and different things like that. So I will be, I'm heavily invested in Apple. And what better thing to do than to own some of the stock when you're heavily invested? And so that's pretty much it. Again, this is FinanceKeem. This is a short video right here, but if you like the content, if you like what you hear, if you like the information that you're learning, please do me a favor. Just click the link and subscribe. Click the link. It'll help the algorithm. It'll boost my ratings on YouTube. And this is something that I'm definitely passionate about. I don't know if you can hear it in my voice, but I do this every day. It's 24/7 with me, and I do it professionally. So this is just an added bonus for you guys in YouTube If you are interested in any of my services for my professional advisory practice, don't hesitate to reach out to me via Instagram at FinanceKeem, via threads at FinanceKeem. Comment down below on YouTube and I will get right to you and we can have a discussion, a consultation on, the philosophy of my practice and how I think or how I navigate a client from step A to step B, all the way through retirement and all the way up to as estate planning. So again, this is FinanceKeem. I'm signing off. Until next time, I'll see you on the other side.